Hello everyone, it's Ted Bauman here with your weekly Friday video from me. This is part of the Bauman Daily series, which we put out every week. It's a free newsletter that goes to subscribers of my newsletter and anybody else who likes to sign up. So if you do come across this video from another source, please consider signing up to our Bauman Daily video and emails, which come out 5 times a week. Today I'm going to talk about options, and one of the reasons for that is because option trading has become one of the most popular ways to make money in the stock market this year. The volume of options trading at one point actually exceeded the volume of share price trading, which I believe is the first time that's ever happened. The reason for that is because in a market that's been as directionless and as up and down as ours has this year, options have really been the only way to make money. Now, if you're not familiar with options, basically they are a way that you can make a deal with somebody to buy or sell a certain amount of stocks in the future at a certain price, and that coupon, that particular contract actually has a value, and it goes up and down in relation to the price of a stock, and over very short terms and even longer terms, you can actually make a great deal of money without having to put too much up. Now, the reason why we're interested in options is twofold. One is because it's become very popular, but the other is because my colleague, Clint Lee, has got a new option service coming out. In fact, next week at Wednesday, October 20th at 4 p.m., Clint is going to be doing something called a Profit Countdown Live with Clint Lee, and he's going to be talking about a new service that he's going to be launching here at Banyan Hill. And here's the track record. This is the backtest that we did between 2018 and the beginning of 2021. This is the relative performance of different tickers versus the new strategy that Clint's going to be launching. Basically, this includes all the winners and all the losers, but it's based on a backtest that would be exactly the way Clint's going to be doing it live in his new service. Now, here is the URL. I'm going to flash it up on the screen, but it'll also be down in the description below. That's to sign up for that October 20, 4 p.m. Event where he's going to talk about this. It's amazing. I mean, I've seen this thing. I've seen the backtest. I mean, it's crazy. I mean, you can do these things, but it takes a specific set of technical skills, and that's what I'm going to be talking about today. I'm going to be talking about the difference between fundamental and technical analysis and why it is possible to get those kind of returns using technical analysis, and why that's so useful to do in a market that is directionless, even one that's going down. So let's just talk about what these two things are. A lot of you guys probably know this, the difference between fundamental and technical analysis, but let's review it anyway. Fundamental analysis tries to find out the fair price of a stock, basically. You're trying to come up with its intrinsic value. You're looking at everything from the overall economy and the market that a company is in, and industry conditions, the company's financial condition, its management, its projected growth, all those kind of things. And you can come up with, using a discounted cash flow analysis, you can come up with what you think is a fair price for a stock. If the stock is less than that fair price, then you buy it. If it's higher than that, then you sell it. That's essentially what fundamental analysis does. Now, technical analysis starts from the opposite end of the spectrum. They assume that basically all that stuff that fundamental people do, in other words, analyzing the company, analyzing markets, that's already factored into the price at all times. Basically, there's no room for mispricing because the market is efficient. Now, that means that the only thing that really matters is the price of a stock and its volume over time. So technical analysis, guys like Clint, he is a certified technical analyst. He's one of a very, very small number of people who have that particular qualification. They use price and volume data to try to find patterns and trends in order to predict what a stock is going to do in the future. Now, here's a look at some of the things that technical analysts do. They look at these kind of indicators: price trends, chart patterns, volume and momentum indicators, things like relative strength index, oscillators like moving average convergence data, moving averages themselves, support and resistance levels, and so on. So basically, those are the kind of inputs that people like Clint use. And the idea here is that what you're doing is you're actually studying human behavior. And the human behavior that you're studying is all the other traders in the market. the only evidence you have of what other traders are doing is price and volume, basically. Those are the two variables that you have. And if you look at those things, you're picking up a sentiment signal. That's telling you what other people are feeling about a particular stock. And you can use those signals in order to get ahead of where you think things are going to go. Now, to do that, technical analysts really use three different types of assumptions. And this is where some people criticize them. Some people, say that it's not that simple, but basically it's got a pretty good track record. I mean, technical analysis goes back to the very beginnings of the stock market with Charles Dow in the 19th century, who really started this whole sort of thing of analyzing price and movements and using charts to try to figure out where prices are likely to go in the future. So the first assumption, and the one that I mentioned already, is that the market discounts everything. Everything that could influence the intrinsic value of a stock is already priced in to a company at all times. You make that assumption in order to basically free yourself to focus on price and volume as the only really meaningful variables. Now, you can criticize that all you like. Personally, I don't buy it. I think that there are many times when you do get mispricing, and most technical analysts will agree with you. But the core of the discipline, in other words, the tricks of the trade that people like Clint learn, is based on using that assumption. Now, there are some cases where that assumption doesn't apply. You get, for example, very small cap stocks that nobody analyzes, that very few people know about. And in those cases, there just isn't enough data in price and volume to be able to determine something. And that's where you can get mispricing. But for the very biggest stocks, for the Apples and the Amazons and all of that, that's exactly what, technical analysis is made for. Everybody knows what's going on at those companies. They publish their quarterly reports, their 10Ks. Everything is out there for you to see. And so therefore, that efficient market hypothesis, what it's called, is actually a good thing to rely on. Now, again, if that's true, if basically everybody out there who's analyzing these companies, millions of people around the world trying to make money in the stock market, like us, are all doing the same thing, then you can assume that whatever the price of the stock is at the moment, that reflects, at least in the short term, it reflects what people think the stock is actually worth. That means that the only thing you can really make money on is price movements in the short to medium term. Now that leads to the second thing that this kind of technical analysis assumes, and that is that price moves in trends, so that there are predictable trends. And if you get into chart analysis, you get into technical analysis, you'll learn about things like cups and handles and all kinds of different chart patterns that are predictable. They are patterns that we have seen before. They're patterns that go back for as long as people have been making charts. Even before the stock market, a lot of this stuff, surprisingly enough, actually comes from the way that rice traders in Japan in the old days and really over hundreds of years used to track the price of rice on rice markets. In fact, that's why you see a lot of the names of some of these technical patterns that people like Clint use actually have Japanese names because they come from this rice market stuff. So this is not something that just happened yesterday. There are hundreds and hundreds of years of analysis of how people tend to behave when they are investing and when they are buying and selling something. And that allows those technical analysts to say, if these things happen, I predict that this will happen afterwards. And that leads to the third conclusion or rather the third assumption that technical analysts make, and that is that history tends to repeat itself. What that means is that really human psychology is predictable. In any given situation, investors will behave in similar ways. It really doesn't matter what you're investing in, whether it's stocks or rice or Bitcoin or whatever. Essentially, people will behave in predictable ways, and that will lead to a real change in the way that a stock moves if you have got the pattern right. So essentially, the study of the past and the understanding of what happens in the past is what allows technical people to get ahead of the market. Now, to a certain extent, this can become a self-fulfilling prophecy because obviously Clint is not the only person doing this. There are tens of thousands of people every day who are using technical analysis to trade. Day traders do it. Everybody from guys and ladies, of course, working in their They're home day traders all the way up to the very top people, at the big investment houses. They're all using the same skills, the same tools, and they're all analyzing the same thing, each other. They're analyzing what everybody else is doing. Now, here's how that can work. If enough people are using those signals, right, that could actually cause the movement that people are predicting. And to a certain extent, that's what Clint's system does. It looks at what people are likely to do in the future if certain things happen to a stock, and then basically placing options orders, whether they're calls or puts, based on what the price is likely to do given what's happened in the past. So let's take an example. A lot of traders will place a stop loss order on a stock if it falls below its 200-day moving average. In other words, as soon as it crosses that price, then they will sell it. Now, if a lot of people do that and that it reaches that price, well, that's what's going to happen, right? Because all those technical traders are going to start selling, and then people who are maybe not technical traders but who see the price action will then start selling as well. And that will lead to exactly what the technical analysis predicted, that that if it reaches a certain point, that you will get a price movement downward. Now, some people say that that's a criticism of technical analysis, but it's not actually, because that's exactly what technical analysis is designed to do. It's designed to predict the behavior of human beings in a market context based on what has happened in the past and what history has shown that the certain patterns that have occurred in the past tend to produce certain results. Now, if that's a self-fulfilling prophecy, it's because that's exactly what we're looking for. We're looking to try to understand things and predict them, which is a prophecy. And if you're good at it, and a lot of people are good at it, then the prices are going to move that way. Now, the critical thing is that the way to play these things in technical terms is really more about trading than investing. If you're going to buy a company to hold it for a long term, none of this stuff matters. And this is where, for example, there's a big difference between my Bauman Letter, which is really a buy and hold strategy. We're buying companies that have great future prospects. We have triple digit winners in there because we spotted where these companies were likely to go, and we bought them, and it turned out that that's exactly what they've done. And so, we're beating the market by a factor of 3 or 4 times over our holding periods. But we don't trade in and out of the stocks. On the other hand, what options traders do is use this technical analysis to try to figure out where price movements are likely to go in the short to medium term, in order to place bets, if you like, on how price and volume are likely to move. If you get those bets right and you do it consistently, you get this kind of performance. Let's show that chart again that I showed at the beginning of the video. This is the back test of Clint's system, the new strategy that he's coming out with versus what happened to these popular assets over the period of 2018 to the beginning of this year. Now, that just shows you the power of it, right? It shows you that it is possible to make a great deal of money. Now, how do you do this? Well, clearly, you are buying options, whether they are, and by the way, we're talking about buying options, not selling them. That's a whole different kettle of fish. You're buying calls if you are betting on the stock price go up. You're buying puts if you're betting on it going down. But the idea here is that you do the trade, you exit the trade when you believe that you've made a significant, the profit that you were expecting, and then everybody else who is doing the same sort of trade is going to pull back at that point, and that's when you want to cash out. Now, not all of the trades in Clint's backtest were successful. Some of them didn't work out because nothing is perfect. But that figure of 1,165% growth over that period in the backtest does reflect winners and losers. Now, that's important to understand because the whole idea is that you're taking a pot of money and you're applying part of it. In Clint's case, I think it was only about 15% of the total at any one time, applied to options trading. But over time, that generates profits that add back into your pool of capital, and that grows it over time. I'll let you do the math to figure out what amount of money applied to a system like that could actually turn out to be at the end of the day, but it's a huge gain, and it's a lot bigger than just buying and holding. Now, you may ask yourself, well, Ted, why are you telling me this if this is the way to make money in the stock market? Well, there are different ways to do this, and buying and holding is really what you should be doing with the bulk of your stocks. You should be buying, you should just be allowing them to accumulate, and then have a smaller amount that you can use for this kind of stuff. Now, You might say then, well, if it's a sure thing, then why not just do it with all of your money? That's because at any given moment, you can have winners as well as losers. And you also get a high volatility in this. You have to do it as a hands-on exercise. Options trading is not for the faint of heart. You've got to be willing to watch your options and move in and out quickly. You can't just buy them and then, let them sit. Yeah, you have to pay close attention. And there's only a certain amount of your portfolio that you can devote that kind of attention to. So the logic here is put the bulk of your money in something like the Bauman Letter, and then have some of your money set aside for this kind of options trading. Now, if that sounds like a good opportunity to you, like I said, Clint will be presenting this next week on Wednesday, October 20th at 4 p.m. at the web address that is down below in the description. And sign up for it. It doesn't cost anything. You can see what's going on. But I'm convinced. I've seen the back test. I participated in it. I did a little bit of trading in the back test myself, and it worked for me. I made some money, and it'd be cool if you could do that too. So I know this is a bit of a pitch today, but I think it's important every once in a while to realize that, we do come up with new things, new ways of making money. And in a market like today's that is so uncertain, with things going up, down, sideways, being able to trade short-term price movements with an expert trader like Clint Lee, who is a certified technical analyst, one of a tiny percentage of people in the market who have that qualification, that's a good opportunity. So take it. Sign up for next week's presentation. If you've got nothing to do at 4 p.m., watch it. If you like it, join the program. I'll talk to you again next Friday. Ted Bauman signing off.